Thanks, Sam, and welcome, Sonja, to one of your first EOL Learning Connect webinars, and look forward to working with you today. The topic today is one that interests primarily smaller servicers. We'll be talking about a definition of small servicers shortly, but I wanted to give you a brief overview of what sorts of things we're going to be covering today. First of all, the servicing rule is probably one of the widest reaching of the Dodd-Frank rules that came out from the Consumer Financial Protection Bureau last January. That is January of 2013. It became effective on January 10th of 2014, so we're just now getting our feet wet as far as compliance is concerned. And it affects two mortgage-related regulations significantly. It made some pretty significant changes in both Regulation Z, Truth in Lending, and, of course, in Regulation X, the RESPA regulation. And one point that we want to make very clear right up front today is that unlike most of the other rules that came out affecting Reg Z and Reg X with respect to the Dodd-Frank rules, these rules impact the loans that are already on your books as of January 10th of 2014. These are not prospective requirements. They are requirements that affect what you've got in addition to what you add to your portfolio between now and whenever. So getting that out of the way is important, and understanding that it does affect your current portfolio is a key compliance fact. Now, what we're going to be talking about today is designed primarily for small servicers, as I said earlier. So we'll be making our focus on those rules that do, in fact, affect small servicers. We'll start off by zooming in on the definition of small servicer, which strangely enough is found in Regulation X, which is not technically a servicing regulation, but it does have some servicing components. And the Bureau, for one reason or another, found it convenient to house the definition over there. But we'll look at both Regulations X and Z, and we'll be making a lot of different stops along the way. If you flip over in your handouts to page 2, you'll see a quick table of the subjects that we're going to be covering today, at least in some depth. And you'll notice that we've checked off, five sections of regulations where we've got an X indicating that there is an exemption for small servicers, and we've mentioned two of them, or we've marked two of them with partial exemptions. And when we get to those sections, we'll make it very clear which ones you have a complete exemption for and which ones include only a partial exemption. The only other thing on the page 2 that I really want to call to your attention is just a note that we've written to remind you that periodically during this text, as a matter of fact, a fair number of the pages of this text consist of excerpts from the regulation. Not because we were lazy, but because, frankly, we felt that it would be helpful to have the regulation in front of you while we're having our discussion. And, of course, we wanted to be able to distinguish the regulation from our comments. So you'll find that the regulation where we have copied it into the materials is set in italic type as opposed to the Times Roman type that we're using for comments and so forth. So with that is by way of sort of housekeeping. Sonja, would you like to start off a quick discussion of what we think is a good definition of small servicer?
Sure would, John. Thank you. Well, as John mentioned earlier, the definition for small servicer is found in Regulation Z, but it applies to both Reg Z and Reg X. And the definition is based on the number of loans that are serviced both by the servicer and any affiliates of the servicer. The key number we're looking for there is 5,000. So a small servicer is a servicer that, together with any of their affiliates, service 5,000 or fewer mortgage loans that they are the creditor or the assignee of. A second part of the definition is a small servicer is also a housing finance agency, but we don't feel that that is probably very relevant to our audience, so we're going to focus on the first part of that definition. When we look at determining if an entity is a small servicer, the number of loans that are serviced have to be looked at a point in time, and that date is January 1st of any given year. So loans are counted as of January 1st every year. The loans that are serviced by the servicer and the loans that are serviced by any of their affiliates are added together. And if they're below 5,000, you're in. You're a small servicer. You get to enjoy some of the exemptions that we're going to talk about. If it's over 5,000, you're out. Now, there are a few type of loans that don't need to be counted at all. And those loans are mortgage loans that you voluntarily service for a creditor or an assignee, and you don't charge a fee for them. And we'll talk a little bit more about those later on. Reverse mortgages don't count, and neither do mortgages that are secured by a consumer's interest in a timeshare plan. Let me go back and make one clarification on an affiliate as far as what an affiliate is, and that would be an entity that is owned by the servicer, an entity that owns the servicer, or an entity that is owned by the same entity that owns the servicer. It's sort of your standard definition of what you think about as an affiliate.
So if you're in a holding company, for instance, if you have your holding company is an affiliate, and the mortgage company is an affiliate, if it's also owned by the holding company, and every other bank within the holding company structure is an affiliate when you're counting these things up. Is that right?
That's exactly right. Thank you, John. Let's take a little bit closer look at those mortgage loans that are voluntarily serviced at no fee. A lot of times these loans are referred to as habitat loans or the habitat exemption or maybe the nonprofit exemption. And that's because a lot of times Habitat for Humanity is the main entity that we think of that has made arrangements with servicers to service their loans. And many times those loans are serviced at no fee. So again, if you are servicing any loans such as those, and it doesn't necessarily have to be for a nonprofit, it's just that's generally how it arises, those loans aren't counted. Now, sometimes we have seen situations where those habitat loans or other nonprofits, rather than having an entity service their loans at no cost, the entity may service the loans at a substantially reduced fee. And if that's the case, and you're charging any sort of fee, regardless of how reduced the fee is, to service those loans, even if you service one of those, that will preclude you from being able to take advantage of the small server exemption. It will preclude you from being a small servicer.
So if you have 300 loans that you service, you and your affiliates, you're a really small servicer, and you have 300 mortgage loans, but one of them happens to be a habitat loan or any loan to a non-affiliate that you're charging for, and you're not the owner of the account, or you're not the creditor or the assignee, that kicks you right out of the definition, and you end up having to follow all the servicer rules. So on page, I think it is 4, there's a comment about two-thirds of the way down. It's just a kind of an aside. If you find yourself in that kind of a situation, it's probably a good idea for you to sit and analyze, is it better for us to go ahead and follow all of the servicing rules because we don't qualify as a small servicer, or is it better for us to either give up servicing these loans or stop charging a fee for servicing these loans? And when I